Is a weakening economy going to drag stocks lower, or is a potential change in Fed policy good enough to keep the rally going? Let's ask Tony Pasquariello. He's the global head of hedge fund client coverage at Goldman Sachs, back with me at Post 9. Welcome back.
Thanks, Scott. Good.
Are you a buyer or a seller of this market?
I've been in the range trade camp for a while. I'm still in that camp. For a choice, I'd probably be a buyer of dips and a seller of rips. I think the first quarter was instructive for all that's changed in the past month or 3 months or 6 months. In the first quarter, S&P was in the box, 3,800, 4,200. So I don't see, for all the big dynamics of the games changing, my guess is we're going to remain stuck in the mud for a while longer.
You keep talking about, in the notes of yours, which have been must-read for me, asymmetry toward bad outcomes. What does that imply?
So even though I do think we're kind of stuck in the range, if I were to observe the tails, I have a hard time seeing the upside tail on the market. And part of that is, here we are still. Do I want to pay 18 times for virtually no expected earnings growth? And yet, as we've seen this week, it looks like the economy's lost a little bit of momentum. I still think we have a regional banking situation which remains unresolved. And so my guess is, if there is gap risk, it's probably more to the downside than to the upside.
So when someone like Jamie Dimon says, you know, this banking crisis isn't over, I'm paraphrasing, obviously, from his shareholder letter this year, you think there are more shoes to drop in that whole story, whether it's on the regionals themselves or the fallout for, let's say, commercial real estate and, frankly, wherever else?
So our banking team was in D.C. last week meeting with regulators and clients. They've published on this. We did a bunch of client calls on the back of that. What I find interesting with big professional money managers is how wide the distribution of views is. Sometimes in this industry, we kind of cluster towards consensus. I think the bid-ask is very wide on this. It's still early days. I think the bulls would say, look, the policy firewall is in place. I think Secretary Yellen suggested they could run that play a few more times. Deposit flight has slowed down. I think the bears would say deposit flight still continues. We don't have a system-wide guarantee just yet. And the regional, kind of the forward earnings power of the space is in question. So I think that's still very much an open question.
What about the Fed and what role it's going to play going forward? If the Fed says, first of all, if the Fed doesn't do anything in May, I know it's like 60-40 at this point on a 25 basis point hike. What happens if the Fed doesn't do anything and implies that we're done?
So as the great Paul Tudor Jones says, the Fed's trying to land a capsule on the moon. I think that mission's gotten harder over the past month. They're on one hand trying to fight what is still a legitimate inflation concern. We'll find out next week with CPI. Core is expected to be 5.6%, which is still a long way from target. And on the other hand, they're attending to this regional bank situation. You know, I thought Bullard was interesting today. He essentially said we have traditional tools to manage inflation. That is the funds rate, that is forward guidance, that is the balance sheet, and then we have a separate set of tools for kind of macro-prudential reasons, financial stability. So they're trying to basically run both plays at once. Our view is the Fed will go 25 in May. They will go 25 in June, and that's done, 5.25. Let the turkey roast a little bit. Where we disagree with the market is the implied cuts.
Well, I mean, yes, they say 5.25. I mean, the market right now is calling you know what on that. Fed funds futures are at, 4.1% by January of 24. So the market doesn't really believe what, frankly, anybody from the Fed is saying. And that, with all due respect, is to the chair himself.
And so part of me thinks that's a probabilistic thing, kind of a distribution of probabilities. I think the market may be saying, look, there's a 75% probability things are fine and the Fed's not doing anything in the second half of this year, and there's a 25% probability they could cut 300 or 400 basis points. You run that through the math, you kind of come out with 85 basis points of implied cuts.
You alluded to it, of course, when it's whether it's the Fed chair himself, ECB, Pres Lagarde herself, Bullard with the idea of these tools to deal with everything. You know, we can fight inflation. We got enough tools in the box that if there are flare-ups on the credit side, not necessarily, systemic risk in the broader sense, but we could just deal with all of it. Do you believe that or not?
I think they need to project confidence. The market is assigning.
Is that overconfident?
Well, no, I think actually, in a way, if you look at the back end of the bond market, if you look at the TIPS market, break-even inflation rates, I actually think the market's given the Fed a fair amount of credibility that ultimately they're going to get inflation under control with a little bit of a risk premium that they need to avail themselves of the lower end of the rate distribution and cut.
But you don't believe that cuts are coming in calendar year 2023.
The House view, the Goldman Sachs view, would be there are no cuts in the second half of this year. And what I think is a little bit interesting about this sequence is how the market has reacted. I mean, I think tech has obviously been the very big beneficiary. I think the best companies in the world, the best balance sheets in the world, flight to quality, flight to cash flows, I think you said, but just almost programmatically, when you have that big move lower in rates, 10-year real rates are 1%. If you look at the TIPS market, I think NASDAQ, the multiple of NASDAQ, very gladly accepts that.